internet except pornography. And the
Well,
funny
good
thing
evening, ladies
is
and
now,
gentlemen, and
20,
welcome.
30 years later, everybody makes money on the internet and pornography is free. Of course, I wouldn't know that from experience, but but anyway.
To add a point to that, Mark, I think folks should put a note under this group number one. You made the really important point that sometimes you're never going to have heard of these companies. That's a good thing.
Yes.
These key leaders, and you've got more stories, but I have some as well, where you're doing your work and all, like, who is this company? Who are these guys? Why are they doing so well? And that's how all of businesses like Amazon, Walmart, the stalwarts of today, they all started there. And so don't be afraid of what you don't know.
That's right. Buying the market leaders, the ones that you don't know. And we have a whole section on that where we're going to talk about buying stocks that you may not be familiar with and how to spot those and so forth. But now let me explain to you about the institutional favorites, because that doesn't mean that you want to stay away from a name just because it's a big name, because they're, of course, these names, Facebook, these were the biggest winners for years and years and years. So it's important to entertain all the stocks if they meet the criteria. However, when you get into these bigger names and they start coming off of very late stage moves and everybody knows them, now what happens is they tend to morph into stocks that create opportunities during bear markets. And they're much more widely followed. So they have what we call a crowded trades, where there's a lot of supply in there. There's a lot of potential selling. So we're going to talk about this later on, but I just want to give you some general oversight on here. Let's move to the turnaround situation, because this is the fourth area that we focus on. And I would say that the first two are where we would focus the most of our attention. And then when you get to the institutional favorites and the turnaround situations, those would be the next in chronological order. With a turnaround situation, you've got a company that has maybe fallen on some hard times. The industry has been underwater. Maybe you have a new CEO, all right? Someone has been running the company very well. A new CEO comes in, you get recovering fundamentals, a refocused business strategy, new strategy. The thing is that when you have a turnaround situation, you're going against what we call easy comps. So now a company that's been doing really poorly, they might have negative earnings or very small earnings. So what would look like a really big earnings report, it's up 50%. Okay, it's 50%, but it's 3 cents versus 2 cents. It's not really what it seems, because they have such easy comps. So with turnaround situations, we want to look for margin improvement, and we want to look for really, really big earnings. The general rule is you want triple digit earnings, at least in the last 1 or 2 quarters. So again, the reason why I'm telling you all this is because for each of these areas, we've got slightly different approaches or tools and tactics that we're going to use. And so you have to know what you're dealing with first. The very first thing is knowing what type of company and industry. Okay, so we're going to take a look at a few. So let's take a look at an example of a market leader. And this is going back to the 1990 bear market bottom. And I also want to point out that 95% of all the examples in here, almost all the examples in here, the ones that are at least the modern day, are all stocks that I personally traded. All right, we didn't go back and just say, hey, let's find what makes our point and go find the best charts. These are all situations that at the time, in real time, without the benefit of hindsight, I was in there trading and buying, some successfully, some unsuccessfully. And that's what I'm bringing to you. All right. It's really important that you understand that we're not just curve fitting the data here. Amazon was one that I was buying right on this day here, 11/16/90. I'm buying it coming out here. Well, that was the week of 11/16/90, but coming right out of that base right there, you can see that the market is down 35%, right? Off in a bear market. That was a pretty brutal bear market. That was right around the lows. Everybody was bearish. Horrible, incredibly bearish. Matter of fact, this particular market right now, where we are right now, reminds me of that market where everybody was so bearish. And this stock was moving into new high ground. It had held up really well. We're going to talk more about this stock later on and get more forensic looking at it. But it was already up 175%. So it looked like, this thing was already made a big move and it was in nosebleed territory. But now when you take a look and you look at it in hindsight, if you were buying there, it went up another 360% in very, very efficient in a very efficient way and was a key leader. And this is a stock that if you go back, Bill O'Neill was buying it around this time, David Ryan, we were all buying this stock around this time. We didn't know each other back then, but just doing similar analysis. So this would be an example of a market leader. All right, now, another one would be something like a lumber liquidators. And I should also point out that you can have a market leader that turns into a laggard and is a disaster, a couple of years later. .com was a perfect example. You had all these stocks that made me and the whole world, a lot of people in the world, a fortune, and then they all collapsed. Like I said earlier, a great company doesn't always make a great stock, and a company that's not that good can actually make a great stock. So again, that might be a little confusing, but we'll talk about that also later on. So lumber liquidators did fall on very hard times later on. However, when coming out of 2012, this stock was holding up amazingly while the market was correcting. It was one of the very first to move up. And this is something, Mark, that you can also address here. And it's the word leverage, right? A lot of people think that the big returns that I've gotten and now at Mark, that we're using a lot of leverage in the way of options or using a lot of margin. In 2021, the U.S. Investing Championship, I did use some leverage. It's sparingly at times, but what I did use some margin. However, you go over my career, I'm in cash way more than I'm ever anywhere near margin. I'm probably on average 50% invested. So very conservative. And even Mark has been in cash for extended periods of time. The leverage that we try to get, okay, is the leading stocks are the ones that can move up much more than the market. So in this case, if you take a look at lumber liquidators, you can see that during the time that lumber liquidators moved up from where it was holding up very well coming off the lows of the correction, it went up 240% when the NASDAQ went up 33%. So that's the leverage that you got. This is where you get real leverage, okay? And you get leverage without increasing risk. When you put leverage on in the form of margin, yes, you are increasing the upside, but you're also increasing the downside. What we're trying to do, and what we do regularly, is create what we call asymmetric leverage or asymmetric volatility, where the goal, and this is really important. This is a super important point. The goal is to cap the downside and to let the upside run. Everybody knows that, right? Cut your losses, let your winners run. But what we want to do is we want to be in a situation where that upside, that alpha, that excess return is on the table. There's that opportunity on the table. And now what we're doing is we're presenting our capital into those situations that have that potential to the upside while capping the downside. And that gives us a skewed bell curve, asymmetric leverage. Can you talk a little bit maybe more about that, Mark?
Sure. And I would,
and how you do.
Our friend Bob Weissman often calls some of these slides or tangents, Marcos, on golden nuggets or golden tangents, and I think this was sort of a really good one, because this is how you can create an enormous return in a short period of time, is getting that leverage over the market, and not to Mark's point, it doesn't mean you have to go 3 times long in your account and take outsized risk. That's the beauty of this strategy, is it puts you in a position to make an enormous return in a short period of time. Again, if your timing is good and if you're in the right areas.
Yes, and one of the things we stay in cash for extended periods of time sometime, and one of the things that allows that is that when times are good and the NASDAQ goes up 33%, we're generally experiencing much bigger returns. We're getting that leverage, and that's the key. And then that gives you the luxury of sitting out through all the noise and the bear markets, and you can make all that up. So the lost time, people worry about being out of the market. We've heard people say there's risk if you're not in the market. You're missing the opportunity. That's absurd. There's only risk when you're in the market. When you're out of the market, there is no risk. Yes, you could miss opportunity, but you're at risk. So we want to be in the market the least amount of time, be in the best stocks, make the biggest gain in the shortest period of time, and that gives us the opportunity to compound. Let me show you another example that's more recent, and that's DocuSign. If you were watching carefully here when everybody was terrified, and we were in the COVID decline, and it looked like the end of the world. The Dow was off 9,000 plus points. And when we first came off the lows, very few people believed that we were bottoming. Mark and I included. We were extremely concerned and nervous when we came up this first rally up. But at the time, Mark gave me a call and he said, "Hey, there's a bunch of stocks that are looking pretty good here, breaking out of bases, but it looks like the end of the world. What do we do? Do we ignore them?" I said, "What did I say, Mark?"
Buy them. He said,
I
trust.
am.
He said, we're going to buy them, but we trust the stocks, which is the same thing he taught me at the very first Master Trader program. That was one of my first questions: is how do you know when the market's healthy and that type, and let the stocks be your guide, was what Mark has and continues to always teach and tell people.
Now, not every situation that holds up in a bear market or it's hitting new highs is going to turn out to be a big winner. But again, this is all about exposing yourself to the potential of big gains. It's like playing aces, right? You're playing aces or kings in a poker game. It doesn't mean you're going to win with aces. But if you play aces 100 times, 1,000 times, 10,000 times, I assure you the bell curve is going to be skewed to the right, and it's going to be a winning hand over time. So this is how you expose yourself to aces and kings and the premium hands, is you're looking for the leaders. Now, in the instance of DocuSign, you can see just coming off, and we're going to talk about some of these in more depth and really get in and analyze them more forensically. Just giving you that perspective. We're still in total perspective mode right now. You can see you got that leverage. You see, again, like the previous example, NASDAQ went up 36% here. DocuSign went up 120 during the same period. So you got that leverage, and very efficiently too. You can see how that trend, that DocuSign trend, has very little downside. There wasn't much volatility. So we were able to do it with very little risk. So now let's move on to the top competitor, because again, we're just touching each of these right now, just to give you an example. So we're going to go back and take a look at Netflix, because this was one that I saw right in my very backyard unfolding. And as obvious as it was not obvious to many, and it wasn't even obvious to me. It was obvious what was taking place, but I didn't really understand how it was going to unfold, exactly where it was going, and the opportunity that was arising. I didn't see that opportunity till way later, which I'll show you in just a second. But if you look back and you look in hindsight as to the way when Netflix came on the scene, and Blockbuster, if you remember back with Blockbuster, of course, you had tapes. You had to go and you bring them back. They would rewind them. If you didn't rewind them, you got a rewinding charge. That was what we had back then. We bring the VCR tape home and watch it, then bring it back. Then Netflix came out, and actually when they first came out, I don't know if you remember this, Mark, because you're definitely younger than me. But I believe it was, you had the DVDs, and
in the mail, yeah.
in the mail, yeah, or you mail them back, or you got them in the mail. So they started off with a better mousetrap. It was a little bit better mousetrap, but it wasn't as good as it got later when it became streaming, which of course was dependent on bandwidth, and that created opportunities for other companies and so forth. So here's the interesting thing about this, though, and look at the intelligence in the market. Okay. And this is why you always want to be looking at the top competitors in an industry. Netflix IPOs almost to the day that Blockbuster tops. There's the new technology coming in, and the competitor, a real competitor for Blockbuster, to the point where it literally vaporized Blockbuster, single-handedly took Blockbuster out and created a new, virtually a new category, streaming video. But it took some time. In the very beginning, you can see the stock, the IPO did well, and Blockbuster topped, but until it really took off, and Netflix and that technology really got legs, and the stock price took off, it was 8 years or so. And I was actually buying, and I'm going to show you this later on exactly where I was buying. I was buying in 2009, 2010, way over to the right here, just before it started blasting off here. But notice how the stock waited. And then finally, when Blockbuster was vaporized, and they were in bankruptcy, they were right around here. They went to bankruptcy. Then, boom, the new guy in town was free to take over the industry. This same thing happened with Michael Kors and Coach. When Coach sort of had this lock on the I guess you would call it the middle priced handbag market for women mainly, where there was these 300, 400, 500, $600 handbags. There wasn't much else in that space where you got this really nice handbag. Of course, my wife would be the authority on this one, and I usually defer to her on these kind of things. But that the Coach bag was a really nice, high quality bag. It was, along the lines of, more of a Louis Vuitton type bag, but the price point was lower, and it was a real niche. And they were really dominating that market for a while, and there was really no really formidable competition. Then Michael Kors came along, and that was where formidable competition came in. And again, just like Blockbuster and Netflix, take a look at Michael Kors goes public here on the top. They changed their name here, by the way, in their symbol. It's CPRI now. It used to be KORS. Almost to the day, again, very close, within weeks of Kors topping. Coach topping. Kors comes public, and look at the difference in the performance going forward over that time frame of going from 2012-ish to 2014. There's the leverage, up 329%, while Coach, in the same industry, they're basically doing the exact same thing. They're direct competitors. Top two. These are top two companies in that particular space and at that price point. Down 56%. Total disaster for Coach, and Kors takes off and becomes the market leader. Again, top competitor comes on the scene. Got to always watch that. And sometimes they move in lockstep. You can get a number of competitors, 2 or 3 of them, and the whole industry does well, and it lifts all boats. Now, we would be remiss not to talk about the ultimate disruptor that came in as a top competitor. Very few companies that I've ever seen, I don't think any company that I've ever seen was ever a competitor like Amazon, because Amazon first came in books. There basically was the competitor for the book market, and again wiped out. Barnes, that whole industry has been wiped out. There's virtually no bookstores anymore. And actually I heard I think it was a year or two ago that Amazon was actually opening up physical bookstores now after they wiped out the whole industry. Now they've got it online, and also I think it was in Washington they had a bookstore that they were experimenting with. But Amazon actually ended up wiping out a whole bunch of industries and becoming a disruptor in all different areas. That's why the stock has been so unbelievably successful and went up 80, 90,000%, because every good is now bought on Amazon. And I think there was a couple of years ago, I saw a study, a research report that said they asked consumers how much do they buy all or most of their products online and on Amazon versus going to a brick and mortar store. And it was like 90%. And for any one store, it was like between 1% and 3%. So 70, 80, 90% of the products are being bought on Amazon. We've never seen a number like that ever, of a disruption across all different industries. So again, this is about disruption. You'll hear that word a lot in Wall Street about disruption. Let's move on, because again, we're just giving you just perspective here. We haven't gotten into any meat and potatoes here, no specifics. There's a lot here that we're going to go over. That's just giving you a broad perspective and give you some history and let you know, what we're talking about, where we're coming from here. So the institutional favorite, one of the biggest movers that I've experienced, and one of the most successful companies of all time, is Cisco Systems. And if you don't know, Cisco Systems are one of the first to be in the area of routers. And in 1990, I actually bought the stock that right off the IPO, off the first base. I think I traded it for 5 points, and then it went up 70,000%. So I did not participate in this big move here, although I did trade it a few times. But this was a key leader that for a multi-year, a decade of leadership that led the 1990s bull market, similar to an Amazon of what it did more recently. And then it became that institutional favorite that everybody had to own this thing. Every hedge fund, every mutual fund had this in their portfolio. And now all you had was supply. You had tons of supply. And then the stock broke down, and now it underperformed for decades. To this day, I don't think Cisco is even back at break even yet if you bought it near the highs. And you'll see this. Another one back then was Qualcomm. Qualcomm made this meteoric rise, and then took 21 years to get back to break even. And that's why you can look at some of these names now, like like Meta, Facebook, and some of these stocks that have had huge declines. And I think you're probably going to see something similar to what you saw in the past here with these previous leaders, where you've got these big breaks now. And while they'll go up, I mean, at some point they'll probably, if the company stays solvent, they'll go up. But you're going to underperform now, and it's going to take a long time before you get back to those levels. Let's go to the turnaround situation. The reason why I use Apple as a turnaround situation, first of all, it's been called the Great Turnaround, because most people don't know, but Apple was virtually extinct back in the 90s when Jobs got booted, and he came back, of course, and the rest is history with all these great products that we have today. But it was a new name, a new stock that nobody heard of. It was a disaster. It was a turnaround situation. It became then a market leader, and now it's become an institutional favorite. And I think it's gone into the laggard category now, or at least certainly an institutional favorite. So this stock has kind of gone through all the categories as a really great market leader will. Start off as a market leader and eventually get over-owned and become a stalwart and become a quality company. And that's what most would refer to Apple now, is a quality company. One thing you can notice, though, is that, of course, the iPod and the iTunes were the very first products that were released. But the success, it wasn't until, iPhone came out, the stock has already gone up, the revenue, everything was already, iPad, of course, came later. This is all on the table, right? You don't have to find some stock that nobody heard of and it's a penny stock, and you have to bottom fish it while it's trading at a 52-week low to find a market leader. These stocks are going to already have a lot on the table, and if it's really has a great product, its management's running the company well, there could be a very long future. So again, you're looking for things to be on the table already, which we're going to talk about. Again, just giving you perspective here. Cyclicals, Mark, of course, recently we've seen a lot of cyclicals, and we've traded some of them. And you can speak to the as far as going back in our own experience with cyclicals. I haven't had a whole lot of success with cyclicals, except from time to time in certain periods. Recently, of course, they're a little more in vogue, but they are cyclical. They don't have that longer term life to them like a secular, so they got to be treated a little bit differently. In your trading, Mark, in the last 12, 13 years, what would you say the percentage of your return has become from cyclical areas?
Roughly 0 to single digits would be my guess. I haven't done the actual, surgical calculation, but I would say it's been small, and it's exactly because of what this slide is showing. That it's the cycles here are inverse. That's, to Mark's point, that's why we refer to them as cyclicals. Once the good earnings and the sales are on the table, that's often when a majority of the move is over. So especially if you're trading, breakouts in stocks that meet, where you can get into the trend criteria and those types of things, that typically is where these moves are often exhausted for this group.
Yeah. And so when you're applying sort of your normal routine or your normal analysis, you've got to take into consideration if you're in a deep cyclical, you're in a steel, you're in a paper stock, even the oils. When earnings are falling, when the dividends being cut, when the PE is super high because you have terrible earnings, news is terrible. These stocks, as long as the technicals are acting well, that's when you want to be buying these stocks. And when everything's going great and the earnings are huge and the dividends being raised and the PE now comes down because the earnings come in, and all the news is good, that's when you have to be thinking about selling them, because again, these are cyclical. They don't have that secular move where they can sustain this for years and years to come, like an Amazon. So again, it has to be treated differently. I'm going to just show you something I call the commodity play, and just give you an example of something that I did have success with. Although, like I said, I don't have success that often with cyclicals that I've in my own experience in 40 years. But I did have one time where the copper prices were soaring. And so I noticed that a company called Encore Wire, which some of you might have heard of, stock was looking really good. It was in a powerful uptrend. It was in a base. It was starting to come out of a base. And I checked into it, and they had a huge stockpile of copper that they had bought prior to this big rise in copper prices. So what that meant is that they could pass the price increases onto their customers, but they have fixed costs, right? They're not paying more for the copper, and that ballooned their profit margins. And as that started to happen, I bought the stock, and the stock took off and doubled in a short period of time. So these are the type of things that you can find, from time to time. And of course, now with inflation and wars, the threat of wars, we've got commodities, some like oil. Of course, some of them have topped. We saw lumber prices and things like that. So they're more volatile. And again, the reason why I'm showing all this is to show you that we want to go in the areas that are more consistent. And I'm going to tell you the best case scenarios and the worst case scenarios are your growth areas where you have accelerating revenues, EPS. You have got very explosive market position. You have sustainable trends, things that are non-cyclical, that are scalable. And the worst are the ones that are more cyclical. They're very capital intensive, like an airline, like things that take a lot of capital. They have limited pricing power. There's a lot of competition that limits your pricing power. Like Amazon, who was a competitor for Amazon? Nobody, virtually nobody. That's why they had this monopoly. You'll go back and see a lot of these companies have a virtual monopoly in their best years. Heavily regulated industries, the margins are under pressure. Their position in the industry is eroding, competition coming in. Those are your contrasting, what you want to see and what you don't want to see. But here's the real reason behind it. And I'm just going to go down to the bottom here. And Mark, we've talked about this a lot. And in your own experience, I think you've experienced this just anecdotally. The groups, when you go back, everything that I do started with just looking at history. All right. I just, like many of you, I read Bill O'Neill's books. I went back and read what the books that Bill O'Neill read, William Giller and Richard Love, Super Performance Stocks. That was the first, Bill O'Neill, if you will. And when you go back in history, and then I look back even further than that, and then looked in a modern time frame and said, do we see something consistent here that's agreeing? And time and time again, over all these periods, the same thing was coming up, that the winners were being fueled by the same criteria, whether it was 1818 or it was 2018, the same criteria, the same groups. Some groups actually evolved or actually emerged as new groups. But when we look back, it was always technology, consumer, retail. Of course, technology back in the 1900s was rails and cars. Later on, of course, it was internet and other things and computers. Drugs, medical, biotech, leisure and entertainment, the bowling boom, styles that come and go, fashion like Reebok, Nike. These are very strong, powerful trends that emerge. And these areas right here, just these four broad sectors, if you will, have encompassed about 70 to 75% of all the biggest winning stocks going back to the 1800s. So this is the first place that we look. Mark, in your experience, you've talked about this many times with our own members with questions that we've had about this. You tend to, in your own experience, have experienced that these groups tend to give you the best results for yourself too, right?
Absolutely. And this is another golden slide, golden tangent, golden nugget here, because I did a deep dive, and I've shared this at MPA a few times, but of my own trading after, I want to say 5 or 6 years, just looking then at every stock I had traded, where did my actual winners come from? And it was overwhelming. I think it was over 90% of them came from these areas. So it was just a reaffirmation of everything I'd already been taught. Oh, and furthermore, a lot of the names of which I sold, far too early, that went on to have much bigger moves, or that I played for multiple pieces of a larger move. Almost an overwhelming 90% of them were from these areas. So that just told me right there, this is exactly where my focus should be, and why I continue to discount, say, the laggards, the cyclicals, and those non-areas, say financials and those type of areas.
Right. So we're looking for those market leaders, those top competitors in these areas. So this is actually the narrowing down process, right? Sort of the first narrowing down process. So my very first narrowing down process, because the market has got 8,000-10,000 stocks. I mean, if you take in penny stocks and a lot of the smallest names, it might be 14,000, 15,000, but a good 8,000 or 10,000, names that are legitimate candidates for purchase. We got to narrow that down, right? We want to narrow it down to the very best. Like I said earlier, aces, kings, queens. We want to narrow down so we're playing solid hands, right? We're not chasing a pair of twos or 7-4 offsuit. We want to be first aiming in the right direction. And that gives us the probability that now we are going west looking for a sunset. So we can potentially find it now. So the first thing I did, this is going way back into the 1980s, is I created what I called the 95% Club. I was doing reverse factor modeling, relying upon the work of, like I said, Richard Love and William O'Neill, and then furthering that work with my own. I wanted to know for myself if this stuff, actually worked in a modern time frame. So I started looking at the big winners. And what I found is that 99% of them during that big move were above the 200-day moving average. 96% of them were above the 50-day during that entire move. 95% of them had a relatively small float. They were small. They were the smaller companies. During that period, about under 30 million shares outstanding. Now you might move that to 50 million. If you go back to the days when Richard Love was doing the study, it was about 10, 15 million. So it only increased very little over 50 years. Earnings acceleration. Somewhere within the previous 8, 12, 16 quarters, there was earnings acceleration. This is, again, goes right with the O'Neill studies. And there was a catalyst. There was some catalyst. Now, this may sound like canceling, and these are definitely some characteristics of canceling, because regardless of the strategy, if you're looking at growth stocks, this is what you're going to find. You're going to find growth. If you're looking at momentum, you're going to find momentum, right? So the things that were on the table already were earnings. Earnings were, in 70% of the cases, they already had 20% year over year earnings in the most recent quarter. So again, you didn't have to guess. You didn't have to buy some company that's doing terrible and get it before it's doing well. The majority of the time, everything was on the table. So you didn't need the guesswork. You just needed to aim in the right direction and start putting these probabilities together. One very interesting thing, and this is what we talked about, having a company that's relatively new. And again, a company doesn't have to be a new company. We're talking about a new stock. You have companies that, like Krispy Kreme, was around for a long time and then goes public. You have companies that are around for a long, long time and they don't go public. They're private companies previously. So, but 80% of all the biggest winners, you go all the way back to the late 1800s to current, 80% are IPOs within the previous 8 to 10 years. And that's not a very long time. That's a relatively new company. All right. One last thing, and then we're going to move on to more perspective, get a little bit deeper, and also bust some common myths, if you will, or common ideas that people have about stocks. What you'll see in a lot of these leaders is that they will be a completely new category. Now, Netflix was a sort of an offshoot of a category, a better mousetrap. Twitter, that's social media, tweeting, whole new category. And we can go on and on and on. You can go back and you can look. And this isn't in really any real order. This is sort of just a crude timeline, just to show you sort of the chronology and how what happens is you'll have one industry will birth another industry, like mainframe computing. Computers then linking up together created LAN, local area networks. That was Novell in the day, back in the 90s. Software, you had all these computers. I remember when I got my first computer, it just had a little green light blinking. It was MS-DOS, and there wasn't much you can do with it. There was no software for it. And it was very confusing. I was like, what do I do with this thing? There's not much to do. Then software, then Windows came out, changed everything, right? Now software. Then we started connecting, and there was data. We had to store this data. And then we connected the computers together internally, and then connected them online. Now you had AOL came into the equation. Dell came out with build to order. You had laptops. Now you had personal home computers. Huge giant breakthrough. That's where Amazon and all these other companies, online companies, took advantage of that. It created that, and then we needed more speed. Now you got all these computers connected, and we're trying to put video on there and all these things that require more bandwidth. That created bandwidth opportunities. Broadcom, then internet search. These are all birthed from the computer, right? The mainframe, starting with when a computer that I'm using right now, I'm on a laptop right now doing this, probably has more power than a computer that took up a football field in 1950. Or a mainframe, an IBM mainframe. Now security, you've got all these computers now, and now you've got to protect them. Cloud computing, we moved it off the computer. Now you were storing it on the computer. Now we moved it off the computer. Social media, it goes on and on and on. Now we're in artificial intelligence, blockchain. It just goes on and on and on. These are all disruptors, disrupting technologies, breakthrough technologies, brand new industries, and spin-off industries from other areas that now create what some call the cousin effect. And they're usually superior mousetraps, superior solutions. So like I said, mainframe, desktop, laptop, tablet, smartphone, Apple Watch. It just got smaller and smaller and smaller, and faster and faster and faster, and better. And that's changed our lives, right? All right, so now you got a really good perspective here to start off. We're going to give you some more perspective in just a second. I'm just going to take we're going to take a quick break here, just for 5 minutes or so, I think, and then we'll come back, and we're going to continue with. We're going to actually come back and talk about valuation and super performance. Some things that you've probably heard about that some people think are important, and we're going to dispel some of those myths and tell you the way that we look at valuation. We did look at categories so far, categorizing the companies, and so what category you're dealing with. And then later on, we're going to talk about how to deal with each of those categories and apply fundamental analysis to them. Again, just giving you a broad perspective. We'll be back in just a second, okay? All right.
All right, guys, that was the first section, which is I should have mentioned to you before we started, which I will be doing throughout the event. That was categories, catalysts, and characteristics. We're going to take a 5-minute break here. We'll be coming back and picking up, as Mark mentioned, on valuation. Take a stretch, do some jumping jacks. I like to get the blood pumping in the morning and get your mindset in motion. We'll be back in a few minutes.